Hi, I'm Max Keiser. This is On the Edge. Let's get right to it. Time now to go to London and talk with Ned Naylor-Leyland of Cheviot Asset Management. Ned, how are you doing?
I'm doing very well, Max. Nice to hear from you and see you.
Excellent. Ned, tell us about this new Pan-Asian Gold Exchange. What is it? Why is it important?
Basically, I'm going to call it PAGE because that's, it's the Pan-Asia Gold Exchange. They've set up a couple of different contracts, or they are in the process of setting up a couple of different contracts. The first one is a retail contract, and the Agricultural Bank of China customers are plugged into that contract, and they will be able to trade it through their computers, and this is very important. But in truth, it's the second contract which is where the real action is. This is the really important thing, and it's important in two ways, Max. The first one is that really this is a stealth move along the lines of the Sun Tzu Art of War Chinese approach, in my opinion, with respect to their own currency, because you are going to be able to access RMB through PAGE as an international investor. I mean, for instance, there'll be no problem in buying a contract on PAGE denominated in renminbi, selling an equivalent contract on COMEX. So that's the currency element of this, and I think this is huge and very, very important, and it gives a sort of a sense of tangibility to the Chinese currency, which obviously isn't the case so far. But yet more important, and probably of interest to you and me, would be the spot rolling 90-day contract, which is going to be starting in Q4 for international investors, because this contract is a real spot contract, Max. And I don't know, there's a lot to explain because, of course, the way that gold trades is quite technical. But the truth is that the way spot gold is traded forever has been through the dominance of Loco London, through the London clearing and settling process dominated by the LBMA members. And that particular market is one whereby you as a purchaser are simply an unsecured creditor of the bullion bank with whom you're doing the transaction. And that literally is the case. So if the bank goes down, you're left with nothing, which is hardly, I would say, people's intention when they buy gold. And the thing that's so important about PAGE is it's giving you an alternative form of contract. So let's use the Gresham's Law example and say, well, this is effectively reverse Gresham's Law. Gresham's Law being bad money driving good out of circulation. Well, this is a good contract driving a bad contract out of circulation, or at least that would be the way I would see it happening, Max.
You're right. So this is, to pick up on this reverse Gresham's Law idea, people are talking about the fact that some country somewhere is going to start trading their currencies denominated in gold. Some are speculating it could be Switzerland. I know Jim Rickards, who's got a lot of visibility out there. He's talking about this return to a gold standard, and countries are talking about this. And part and parcel with this reverse Gresham's Law is you could add another concept here, which is game theory. In other words, as soon as someone starts trading their currency denominated in gold, it acts like a huge vacuum sucking fiat money from around the world to that gold-backed currency, because people would rather own currency that's backed by something tangible like gold than holding fiat currencies, let's say the U.S. dollar, where the Federal Reserve Bank, as we know, especially recently, anytime they're faced with a crisis, they just print more, and it debases that currency. So is this PAGE, this Pan-Asian Gold Exchange, is it one step down the road toward getting us to the point where a country, is possibly China, is going to come out with a gold-backed currency?
Well, I think it's an acceleration of the trend, Max. I don't know about the specific answer to that question. It's a difficult one for me to give you. But yes, in principle, I think that's right. And I think it looks obvious to me. I mean, obviously, we have a particular perspective on markets here, but I would say that this looks like really an attack on the hegemony of the Western banking system. Because remember that the solvency of it depends on the management of the gold price, or the maintenance of the existing price discovery mechanisms. And what this does is provide an alternative price discovery mechanism, bearing in mind there's going to be a fix as well, Max. They're dealing with that at the moment. There's going to be an 8 a.m. Beijing fix for this new international contract. And the Western banks, effectively, when you deposit funds within the LBMA system, you're lending money to a bullion bank, and they charge you for the pleasure, I might add, at which point you become their unsecured creditor, and they can use those funds in pretty much any way they want. So what you've got is a situation where, to try and think of a worthwhile analogy here, if you imagine the idea of wag the dog, lots of people have always said that the COMEX, the futures exchange, wags the spot dog in gold. What I would say is I would just extend it a little bit further and say, actually, it's not quite like that. What it is more like the dog with the tail, and then you've got people behind wagging the tail, but with the compliance of the dog being the LBMA spot system, the tail being the futures market, and the people wagging it effectively being the banking system. The difference now is there's a potential for the dog to turn nasty, to bare its teeth and turn on the person wagging its tail. And that's the way I see it. I mean, it may seem a bit of an obscure analogy, but it's important to try and put this in a way where people can understand and consume the information, which I believe is very important.
Well, what you're talking about there is the failure for robust and accurate price discovery. In other words, there's a lot of demand for gold, physical gold, but for some reason that's not translating into price discovery. The price, even though it's been on the move, on the upside for years, it's still capped from a lot of nefarious activities, and what many have argued, and I would agree with, boils down to market manipulation. But I want to talk about the political dimensions of this a little bit, Ned. We have folks on this show talking all the time about the role of the dollar as the reserve currency, and the fact that the dollar ultimately is backed not by gold, as everyone knows, but it's backed by the U.S. military. We've had economists on this show like Dr. Michael Hudson. We've also had Catherine Austin Fitts. And they've said that, look, at the end of the day, the dollar is backed by the war machine, the Pentagon. That's what backs the dollar, and that's the status quo, and that's going to go the way it is going forward. Now, you started off today saying that this is an attack on the Western banks. Presumably this means an attack on the dollar, and it's part of a war that's going on between China and the West. China has trillions of dollars in reserves. So a few questions here. What about their dollar reserves? Are they willing to sacrifice those dollar reserves, number one? Number two, does this exchange give them enough of a buying power to accumulate gold in an accelerated fashion that they can't do already because of the scarcity of getting gold, physical gold on the open market? Does this give them another way to accumulate gold, and perhaps their citizens to accumulate gold? And three, if you take away the military from backing the U.S. dollar, does that mean that the U.S. war machine in places like the Middle East, in places that we see the war machine of America everywhere, does that mean it's going to be decapitalized to a large degree?
I'm not sure that it's just the military might of the U.S. I think that in a way what I'm sort of getting at here is the fact that, yes, of course, that's hugely important. I couldn't possibly suggest otherwise. But I would also say that it's the nature of a monopoly, Max. It's just the way it is. Whereas what I'm saying about Page is it's starting to actually change the picture and say, this is not going to be a monopoly forever. The dollar's dominance as the reserve currency and its ability to manage political systems and political changes through its currency and its military. But it just seems to me as though this new exchange is a way for China to say, we've got all these dollar reserves, we've been spending them. I've said to you before, I think, that I've always been of the view that the Chinese have been posting their treasury bonds as collateral to Western banks and then using that money to buy real assets anyway. So I think you need to bear that in mind. But I also would say that, that you've got to think of it of them. Their dollars are like sand passing through their fingers. There comes a point at which it doesn't really serve purpose to carry on worrying about the dollar. They need to accept the fact that they need to step forward themselves and take this role that everyone is expecting them to take, and it was always going to happen at some point. It just looks to me as though Page may be a very key component of that. Bear in mind that the Chinese government have been intrinsically involved in this. This isn't some random exchange in Yunnan province they've had nothing to do with. SAFE, the Foreign Exchange Administration, and the government themselves are absolutely involved with this, and they're fully aware that they are opening up renminbi to international investors via gold, and therefore changing the dynamics of global currency markets. I mean, we'll have to, obviously it remains to be seen what will happen. This is the early phase of this story, and we're talking about it very, very early. But from every angle that I'm looking at it, and I'm speaking to them personally, it looks very, very important.
So, of course, many argue that you've got a duopoly in place with the COMEX and London Bullion Markets Association, and the price or the fix of that price is very much controlled not by supply and demand, but by the political interests and the front-running interests of these organizations. So, Ned, you're saying that, first of all, this new exchange, the Pan-Asian Gold Exchange, they're going to give us a fix. That means we've got explain exactly what that means and how that plays into the global situation. And go ahead.
Well, I was just going to say about the fix, specifically, they're speaking at the moment to 6 Chinese banks to get real pricing, 8 a.m. Beijing time. So first of all, it's not involving the Western banks. And here is a market where the fix is being fixed on the real gold price, on a real allocated gold price. And so it's likely to start to generate arbitrage opportunities which aren't available at the moment. I mean, if you look at the way that gold and silver are trading, the pricing in Asia is different than the pricing in the Western market. And I think it's going to be very difficult, particularly over in the US in the second part of the day, for them to paint the tape in the same way that they can now, knowing that they've got a proper fix going on in Beijing and that they've got a real market where when you buy a contract, you own title to a bar of gold. And if you choose to, very important point as well, Max, is if you choose to lease that gold, you lose the title when you lease the gold. Because bear in mind, of course, that the very important and integral to the way the system works at the moment is this massive amount of unclear leasing and swapping that goes on. And that's not going to be the case over there. The Chinese do understand the way it works now, and they understand the way that it should work. And I think that the key point is the fact that a lot of people that own gold through the LBMA system don't really understand what they have. And when they're shown an alternative like this, where you get the opportunity to own renminbi as well, and you get that certainty and security of actually having title to metal, rather than, as I said to you before, being the unsecured creditor of a bullion bank, I think that it's going to become fairly obvious what's better. Now, it may be that some players, the bullion banks themselves, want to forego certainty for liquidity at the beginning stage of this new exchange opening. But for the guys that want to own physical, I see the incentive to move over to Page to be extremely strong.
Okay, right now we've got a system of, you talked about the RMB. These are priced in RMB. It's a way to own RMB. The RMB ownership is not widely available. I just saw a story last week, for example, that there are people queued up in lines outside of a Chinese bank in New York City to buy RMB and to put their savings into RMB because it's not widely available through the global banking system. But explain to me a little bit about how this would affect, if it does affect, or what the relationship is between the current peg. The RMB is pegged to the dollar. They maintain that peg. The Treasury Department in the United States under Tim Geithner wants, telling the Chinese that they should relax this peg and let the yuan appreciate, etc. Now, how does that? What are these? Are these two bookends of the same problem? Is it this? Do they overlap? Is this going to affect that exchange rate? Is it going to become a policy issue? Should Tim Geithner be frightened of this? Should he welcome this? Is it going to be a welcome development in terms of what's happening in Washington?
Well, inherently, the fact that the Chinese government and SAFE are involved, it shows it's a policy issue for the Chinese. I mean, there's no question about that. I mean, obviously now we're speculating, trying to work out what we think will happen, but my view would be that you're going to see fairly immediate interest in this contract, which will lead to demand for RMB, and so therefore, yes, I would imagine it will start to lead to a move, whether that's formalised at a government level or exactly how that rolls out. I'm not entirely sure, Max.
How does it work with the peg? In other words, if you're buying this, it's gold denominated RMB.
Yes, and it's an RMB.
But you have it pegged with the dollar, so it's always going to be. They're going to have to do something about this peg because it's still pegged to the dollar in terms of getting a dollar.
That's right. What I think will happen, Max, is you'll see the price discovery in gold change quite radically, quite quickly, which will lead to the issue about RMB and the dollar peg and the relative value in FX markets becoming a big issue, at which point it will be. Obviously, like you say, there has to be some formalization of the process because there is a peg, or at least a synthetic one. And I imagine there will be some free floating going on, but I would expect that to happen after the price discovery changes in the gold market, because you're seeing. Remember that you're buying gold as your route into the renminbi, and if we start to see gold and silver move up dramatically on the back of the improved contract terms that you get there, then by dint of that, it's going to bring up all these currency market issues that are extant. And at some point, it was always going to happen. There was going to be this free-floating RMB issue, and it was always going to happen. And I just think that this is going to be the catalyst. Exactly how it rolls out, Max, I slightly back off from speculating because I don't know.
Okay. Well, you started off by, characterizing this as part of a war, a currency war, you could call it. And part of that currency war is obviously gold. Gold is playing more strategic role in everyone's economy going forward. Robert Zoellick of the World Bank hinted that he wouldn't be surprised if there was a return to the gold standard. Many analysts are talking about a return to the gold standard. Central banks are net buyers of gold. So let's look at the global gold ownership position for a second. You've got Germany with 3,000 tons. You've got China. Well, I should say the U.S. has 8,000 tons in Fort Knox, presumably. But China is woefully underrepresented in gold. They've got, I believe, something like 1,000 tons. And they've said they want to buy 5,000 more tons. Of course, that's really virtually impossible because it's just not available on world markets. Give us a picture of the geoeconomic picture here a little bit. China, they want to get more gold, Ned. They need more gold. Are they going to be able to get this gold? And I don't understand how they're going to get this gold. Explain to me how they're going to get. How is the People's Bank of China going to get another 5,000 tons of gold? Is that possible, Ned?
Okay, give you a little speculation here. What would be stopping the state-owned enterprises through which asset purchases will be deployed by the Chinese government from doing what I said earlier, which is posting treasuries with Western banks who consider US treasuries to be the finest form of collateral? I'm not sure you and I would agree with this, but that's the way they feel about it. At which point they release funds for the state-owned enterprises to buy stuff. And why wouldn't they go through the LBMA system, hoover up lots of gold, and let's just speculate a little further and say, well, this new exchange, one of the crucial points is that the gold will be stored in Kunming City in Yunnan province, because that's the very nature of a properly physically allocated market. The gold has to be there. So what we're talking about is the need to transfer a good amount of it from Western banking centres, etc., and pull it across to within the Chinese system. There are myriad ways they can do it, and you know better than to take statistics at face value, and I certainly don't. So I wouldn't pay any attention to any central bank holdings particularly. It's interesting to hear what they have to say, but seeing as there's such a lack of visibility on every level, whatever statistics they do come out with, I would certainly take with a very large pinch of salt. So exactly how they go about it, whether they've already done it, what kind of controls may come in the future, or simply the fact they've started this new exchange which will drain physical and end up with it being banked in China. There are many ways to go about it, but what I will say is that I'm very confident that the Chinese have been thinking about this in a strategic way, which is certainly not the case over here, because as you and I know, policy is driven by short-termism here rather than through long-term strategic thinking, which it is in Asia.
All right, now many said that when Hong Kong opened a gold vault last year, that would drain supply from London and New York. Did that happen?
No. I don't think it did happen. I think there's been some movement at the margin. Apparently it's a very good facility in Hong Kong Airport. But I'll give you another extension of that. Is there's been a new exchange open in Hong Kong as well, and people have been talking about that. And silver went live yesterday. Well, yes, they did one 20th of the volume on COMEX yesterday. But this is a futures market. It's another inverted commas deliverable futures market, but it's just an extension of the tail I described earlier, which is very important. The dog spot market, 10 times the size of the futures market, and the futures market is the tail, and this is just another extension of the tail into Asian trading hours. But as I say, the key thing is that spot market. That's the beast. That's the thing which really matters. And by changing the dynamics of the dog, it can turn on its handle and bite it. And the meaning of that, of course, is that the people wagging the tail will short cover very quickly because they don't want to get bitten.
Let me ask your opinion about a piece recently written by Paul Krugman of the New York Times. He was castigating people who are buying gold as trying to instigate hyperinflation, and that somehow this was anti-patriotic. And he mentioned that the supply of gold is very small, and that only a handful of people could do this. They could drive the price of gold much higher. So what do you think about his comment, number one? And number two, if that's true about gold, isn't it 100 times more true about silver?
Well, yes, I mean, that's true. I would say that people buying gold to accelerate hyperinflation is absurd. I mean, that's clearly not the case. But I think a lot of it relates, Max, to also a lack of understanding about the derivative market. You know, that is obviously crucial to everything to do with financial markets now. And again, people seem to labour under the illusion that everything nets off, so that's just not an issue. It's just something that exists, but there's no relevance to it. It doesn't affect anything. But you and I know that's not the case. Of course, it doesn't all net off. They can only see individual counterparties of individual trades because it's over the counter, so no one knows what anybody else's exposure is. The system as presented is A, and the system as it really is B, and you're either with that or you're not, in my opinion.
All right. Well, we'll look forward to this to see how it impacts the global market. A truly very exciting development. Thanks so much for being on the Edge, Ned.
A pleasure to be with you as always, Max.
All right, and that's going to do it for this edition of On the Edge with me, Max Keiser. I want to thank my guest, Ned Naylor-Leyland of Cheviot Asset Management. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.